Welcome to Talk Tickers, your shortcut to fluency in the world of earnings calls. Today, we are doing a deep dive into the Q3 2025 results for Tryg. They're the major Nordic property and casualty insurance powerhouse. And our mission today is really to understand something fascinating. Tryg delivered genuinely strong operational results, beating key underwriting metrics. But the market just sort of reacted with a yawn, closing down slightly.
Yeah, just a little bit.
So we need to unpack that core strength, look at the huge strategic shifts they're making, like this massive IT pivot, and figure out, well, what did the street miss? Or maybe what actually spooked them?
That market reaction, closing down just 0.36%, that really is the puzzle piece here, isn't it? It tells you the initial read was, confusing. It was a classic tug of war.
Yeah.
You had this quality beat on the core business, the underwriting, but then this noticeable softness in investment income, and I think crucially, some lingering questions about their growth ambition.
Okay, so let's start with the financials then, because this seems to be where that market confusion began. The headline, GAAP earnings per share, DKK 2.43. It was technically a beat.
Technically, yes.
However, if you look at the implied operating EPS, the number analysts really watch, consensus was DKK 2.66.
Yeah.
And they missed it. So why did analysts focus on the miss? What's the key difference there?
That's the critical distinction. Operating EPS is what analysts truly care about because it tries to strip out all the noise, the volatility you get from investment markets. It focuses purely on how well the insurance business itself is being run.
Okay.
The GAAP number includes everything, volatile or not. So the fact that the P&C operations were strong, really strong, meant the drag had to be coming from outside that core business.
Which brings us right to the underwriting figures.
Exactly.
And this is where the story gets genuinely interesting, I think.
Yeah.
Profit before tax, PBT, came in strong at DKK 1,980 million.
Right.
That beat consensus. And their core metric, the insurance service result, or ISR, was DKK 2,181 million, comfortably ahead of what people expected.
Right. And the combined ratio, or CR, that's the single most important number here. For anyone listening who maybe doesn't follow insurance every day, the combined ratio tells you basically for every premium dollar the insurer takes in, what percentage gets spent on claims and expenses.
So under 100% is good.
Under 100% means the core underwriting is profitable. Anything below that is gravy.
In Tryg CR.
Phenomenal. 78.6%. That was a substantial beat against the consensus estimate of 79.2%. And it's firmly in industry-leading territory. Plus, the expense ratio stayed really tight at 13.3%. Pure, disciplined underwriting excellence.
Okay, so if the underwriting was that clean, that tight, what was the definitive drag? What caused the stock price to just stall?
It was absolutely the investment result. No question. It came in sharply lower, just DKK 177 million. Now, compare that to DKK 526 million in the same period last year.
Wow, that's a big drop.
It's huge, a 66% year-over-year fall in investment income. Even that operational strength couldn't fully offset it. And that's what really tempered the enthusiasm, made the overall earnings picture look just a bit soft.
Got it. Okay, before we dive into strategy, let's quickly touch on capital and payouts. Solvency ratio, their capital buffer that increased, right?
Yeah.
To 204%.
Yeah, up from 199% in Q2. Really robust.
And they declared a quarterly dividend of DKK 2.05 per share. That's a nice 5% increase year over year. So a very healthy financial position, despite that softer investment quarter.
Exactly. They clearly have capital to spare, and we definitely need to circle back to that 204% solvency ratio later, because I think that's a massive part of the investment thesis going forward.
Okay, sounds good. Let's transition then into the nuts and bolts of the operational performance, starting with the underlying profitability story. Where exactly did that fantastic CR improvement come from?
Well, the underlying claims ratio improved by 30 basis points across the whole group, which shows continued positive momentum. But the acceleration was particularly noticeable in the private segment.
Oh, really?
Yeah, the improvement there hit 30 basis points, whereas it was only about 20 basis points in the preceding quarter. And this isn't just luck, it's specific actions working.
And geographically, the driver seems pretty clear. Norway.
Yes, absolutely. Management was quick to highlight this. Their profitability initiatives, things like rate increases, adjusting deductibles, they're proving wildly successful in Norway, especially in motor and property lines where Tryg has significant exposure.
How successful?
Get this. In the first 9 months of 2025, the accumulated combined ratio in Norway has improved by over 500 basis points. 500. That's a total game changer for a regional segment.
Wow. Okay, contrast that with the other regions then. Sweden.
Sweden did very well, actually, boosted by higher runoff results, which is, profit recognized from prior year reserves. But Denmark, their home market, saw performance slightly hampered.
Why was that?
Mainly the impact of the July cloud bursts. Concentrated weather claims hit them there, and this led directly into a key concern for analysts on the call: customer retention. Right. Because they've been putting through price increases.
Exactly. Following significant price adjustments in Denmark necessary to maintain margins against high inflation, retention rates did dip slightly. Management's defense here was crucial.
What did they say?
They argued the trend is stabilizing, particularly in private lines, and they pointed out you need to look past a DKK 50 million technical revenue one-off they had in the prior year comparison. They're essentially saying, look, we chose margin stability over just keeping volume, and we think the worst of the customer reaction is probably behind us now.
That makes sense. I mean, you don't get to a 78.6% CR without making some tough pricing calls. But that focus on core efficiency, it leads us naturally to the biggest strategic headline of the quarter: the simplification pillar.
The big one.
The massive 7-year, $550 million outsourcing agreement with Tata Consultancy Services, TCS. What does this actually mean beyond that huge price tag?
It means they are fundamentally rebuilding their operating model. This isn't just, outsourcing a few call centers. This is a deep structural IT overhaul. The core goal is simplification and scale. They are aiming, and this is pretty ambitious, to reduce the number of ways IT is developed across the entire group from 10 distinct approaches down to just one.
10 down to 1.
Exactly. When you standardize a complex system like that, the potential savings become enormous and sustainable.
And those savings, they're already being factored in structurally, aren't they? Management signaled a big efficiency drive is coming. They noted the IT organization will see about a 33% reduction in employee count by 2026.
Precisely. This is about future-proofing the expense ratio for the long haul. And it feeds directly into another strategic move they highlighted: asset de-risking.
Right, the property sales.
Yeah, they're actively selling off physical properties, reducing real estate exposure from DKK 3.3 billion in Q2 down to DKK 2.9 billion in Q3, and they flagged further sales plan to hit DKK 2.4 billion in Q4.
Why the property sales, though? I mean, doesn't that sound like they're minimizing potential returns, getting rid of assets?
They're explicitly minimizing volatility. That's the key. This lines up perfectly with their capital market day commitments: exit risky assets, lower capital consumption, and crucially, minimize the chance of investment income swings messing with earnings.
Addressing the exact problem we saw this quarter.
Exactly. By selling these assets, they increase their return on own funds, the capital they actually deploy, and make the balance sheet safer and more predictable, less slumpy.
Okay, this all brings us to what felt like the central tension analysts had with management on the call. If you have this elite, industry-leading combined ratio of 78.6%, why are you talking about a target CR of around 81% by 2027? Why intentionally let your margins slip?
Yeah, it sounds counterintuitive, doesn't it? But management sees this as coming from a position of strength. They argue that having such a tight margin structure actually gives them the license to reignite profitable commercial growth.
So growth is back on the agenda.
Profitable growth. They were very clear. Not growth for growth's sake. Their historical pre-inflation growth was in the 4% to 7% range, and that's the kind of profitable trajectory they want to get back to.
So they're willing to maybe trade that 78.6% gold standard for a bit more growth, but only within a strict band that still keeps them highly disciplined compared to their peers.
Yes, they absolutely conceded that selling new business, especially in profitable areas like Sweden, will put some upward pressure on the group CR, but they feel they have ample room to maneuver towards that 81% target. It signals, I think, controlled ambition, prioritizing long-term market share gains over just maximizing short-term margins.
Okay, let's pull the lens back a bit then and talk about the investor context. Specifically, let's go back to that massive solvency ratio, 204%.
Right, the 204%, it's a fantastic number for regulators, keeps them happy, but frankly, for shareholders, it's arguably too high.
So much capital sitting around.
Pretty much. It's well above their own historical operating level, which management has previously said is more like 175% to 180%. Now, that conservatism was probably useful during recent market volatility, but excess capital just sitting idle doesn't generate shareholder value.
And here's where it gets really interesting for investors, right? Management didn't shy away from this topic on the call.
Not at all. They reiterated they will review the solvency position at year-end, and they specifically said they'll consider extraordinary capital return if appropriate, noting, and this is key phrasing, that many things are pointing in the right direction.
And we know what those things are.
Oh, yeah. Operational earnings are strong. The asset de-risking is continuously freeing up capital requirements. Less risky assets means less capital needed against them. They even noted that the Q4 asset sales alone will provide about DKK 50 million in capital relief.
So the financial strength just keeps building, making a large payout seem highly probable.
It really does. This capital stability is the foundation for their 2027 targets, maintaining that CR around 81% and returning a massive DKK 17 to 18 billion to shareholders by 2027. That's the baseline promise.
And one final detail we should probably mention is the customer experience catalyst.
Good point. They're focused on improving customer satisfaction. They're at 82 now, aiming for 83 by 2027. It's not just corporate fluff. They're directly tying it to commercial success.
How so?
Through new initiatives. They cited new Swedish motor partnerships with Subaru, Carla, an expanded deal with Hydane Automotive, specifically aimed at increasing private motor share in Sweden. And they expect that to boost premiums by about DKK 300 million toward that 2027 goal. It shows the link. Operational quality driving commercial execution.
Right. Okay, this brings us perfectly to our favorite part of the deep dive, the This Is Not Financial Advice segment, where we take all this, the operational excellence, the strategic pivots, the management tone, and formulate one outrageous but plausible trade idea for you to think about.
All right. Given everything we've discussed, we are proposing a long bet on Tryg, driven specifically by the expectation of an outsized, extraordinary capital return announcement at year-end.
The rationale feels simple, but potentially powerful. The market seems fixated on that soft Q3 investment income, maybe a bit confused by the controlled growth strategy. And because of that, the stock stalled. It seems to be completely overlooking the capital structure catalyst that's staring us in the face.
That 204% solvency ratio, that's just highly conservative. You could almost say dangerously high from a shareholder return perspective.
Right.
The company has strong operational earnings just pouring in. The strategic asset de-risking program is systematically reducing the capital required to run the business day to day. When management reviews this properly at year-end, the math looks almost unavoidable. They have too much capital.
And that review is highly likely, we think, to trigger a large, extraordinary capital repatriation.
Yeah.
And that would likely be beyond the already announced DKK 17 to 18 billion commitment.
Exactly. And the current stock price, which basically just shrugged at these strong Q3 operational results, seems to be fundamentally underpricing this potential capital structure catalyst. It feels like a timing opportunity, potentially, to position for a massive non-operational return event.
Okay, so to synthesize our deep dive into Tryg's Q3 2025, this was fundamentally a clear operational beat, defined by that elite combined ratio and the phenomenal turnaround story unfolding in Norway.
But the market focused perhaps too heavily on the temporary investment income drag and maybe misunderstood the necessary, albeit slightly ambiguous, trade-off between maintaining peak margins and reigniting profitable growth.
Tryg is executing a very deliberate long-term plan. Simplify the business, de-risk the balance sheet, and that's putting them in an extremely robust financial position that few peers can really match right now.
Solid foundation.
Before we close then, here is one final provocative thought for you to consider. Tryg is committing to reducing its IT staff by a full 33% by 2026. That's part of that massive PCS simplification deal. How quickly do those structural savings actually translate into tangible drops in the expense ratio?
And maybe more importantly, is the long-term compounding efficiency benefit of that huge strategic overhaul being deeply undervalued by investors right now? Are they too preoccupied with a temporary dip in investment income to see the bigger picture?
Something to think about.
As always, please remember, this is absolutely not financial advice. It is simply our analysis and interpretation of the earnings call, transcript, and related materials.
Thanks for joining us for this Talk Takers Deep Dives. We'll talk to you next time.